after interest is considered. If you are solicited to buy life insurance, you should ask the agent to give you interest-adjusted cost data on the policy. You should also request similar information from other insurance before you buy. You want to avoid purchasing a high-cost policy. Research studies show there is substantial cost variation among insurers for similar policies sold to individuals the same age and gender. One study of 13 participating whole life insurance policies issued in the amount of $250,000 to a preferred risk non-smoking male age 45 showed significant cost variation among insurers over a 20-year period. All dividends were paid in cash. The period covered was 31st of December 1990 to 31st of December 2010. Based on actual cost, the surrender cost index over the 20-year period ranged from a low of minus 0.24 per 1,000 for the lowest cost policy to a high 4.14 per 1,000 for the highest cost contract. Likewise, based on actual cost, the net payment cost index for the 13 policies ranged from a low of 10.08 per 1,000 to a high of 19.99 per 1,000. Unfortunately, most consumers do not consider interest-adjusted cost data when they buy life insurance. Instead, they only use premiums as a basis for comparing costs. However, using premiums alone provides an incomplete comparison. Interest-adjusted cost data will give you more accurate information about the expected cost of a policy. If you use interest-adjusted cost data to compare policies, keep in mind the following points. Compare only similar plans of insurance. You should compare policies of the same types with the same benefits. If the interpretation cost data, the lower the number, the less costly is the policy. Next, shop for a policy and not an insurer. Some insurers have excellent low-cost policies at certain ages and coverage amounts, but they are not as competitive at other ages and coverage amounts. Ignore small variations in the cost index numbers. Small cost differences can be offset by other policy features or by services that you can expect to get from an agent or insurer. Next, cost indexes apply only to a new policy. The cost data should not be used to determine whether to replace an existing policy with a new one. Other factors should be considered as well. The type of policy you buy should not be based solely on a cost index. You should buy the type of policy that best meets your needs, such as term, whole life, or some combination. Once you have decided on the type of policy, then compare costs. Our discussion of life insurance costs would not be complete without a brief discussion of the life insurance policy illustration model regulation drafted by the National Association of Insurance Commissioners. The majority of states have adopted the model regulation. The Model Act requires insurers to present certain information to applicants for life insurance. The policy illustration contains a narrative summary that describes the basic characteristics of the policy, including how the policy functions, underwriting class, death benefit option, payment of premiums, and any riders. The narrative summary also describes the elements of the policy that are not guaranteed, like federal tax guidelines for the policy, key definitions, and interest-adjusted cost data. In addition, the policy illustration has a numeric summary that shows the premium outlay, value of the accumulation account, cash surrender values, and death benefit. 3 policy values must be provided based on current interest rate credited to the policy, based on guaranteed minimum interest rate under the policy, and based on midpoint interest rate. The illustration also shows the number of years the insurance protection will remain in force under the 3 sets of interest assumptions. The applicant and agent must sign the illustration and indicate they have discussed and they understand that the non-guaranteed elements in the policy are subject to change and can be higher or lower than the values shown in the illustration. Certain deceptive sales practices are prohibited in the illustration of policy values. Insurers are prohibited from using anticipated gains from improvements in mortality in the sales illustration. The term vanishing premium cannot be used, and the values shown in the illustration must be justified by a self-support test. Finally, the insurer must provide an annual report on the policy and notify the policyholders when a change occurs in the dividend scale or individual pricing elements that would negatively affect the policy values. The model regulation should reduce misunderstanding of policy values by policyholders and reduce deceptive sales practices by agents.